Hello folks, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. These will be for Friday, the close of May 5th, getting ready for the open on Monday, May 8th. Before we get started, just encourage you to subscribe to our channel. That would enable you to get noticed whenever we post a new recording. Also, you could click on the link and get a free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Today we have two reports for you, the S&P 500 Condor Butterfly Timing Report. This is for those of you advanced options traders using these strategies, looking for a better edge in terms of when to begin your campaign, your Condor or Butterfly trading campaign. And so we use some technical analysis studies to examine whether now is a good time or not. Also, another report we have is the S&P 500 Directional Likelihood Report, where we look at the current market condition, see when it's occurred in the past, and what did the market do, when it occurred then. So we have a way of measuring that and coming up with some interesting results. So let's look at the current market condition. We have here a trend upward. We are above our 50-day simple moving average. We have had two successive upswing days where the high was higher than the previous day, the low was higher than the previous day. That's happened the last 2 days, Thursday and Friday. That's occurred also when the stochastic, the 15-3 stochastic, is overbought between 70 and 100, and it's above its 3-day simple moving average, or %D. So that all creates a market condition that has occurred quite a bit in the past, over 200 times. And so let's go to the first report for those of you trading condors and butterflies, and let's just read the narrative here, and away we go. So since January of 2000, there have been over 4,300 daily closes of the SPX. Now of those, and it's actually 4,327, 65% of those closes have proven favorable for selling option premium, where the actual 21 bar movement moving forward was less than what was being implied by the SIBO skew adjusted the VIX. Okay, so also during that time, so again, 65% of the bars turned out to have been favorable. That's the benchmark. Also during that time, the current condition I just showed you has occurred 317 times. That includes consecutive occurrences. Okay? Now of those 317, almost 72% have been similarly favorable for option premium selling. So if the benchmark's at 65 and our current market condition, 72% of the time it ends up being favorable, what's our edge? Our edge is basically, well, it's 71.9 minus 65. We have an edge here of 6.9%. That's not too bad. Okay, so statistically, it's more likely than usual that Friday's bar will end up being favorable for market neutral option premium selling. Okay, so that's the results for this report. Those of you that trade condors and butterflies, you can see that you have a statistically validated edge. Okay, no guarantees, of course. All right, we know that, but at least you know that this market condition we have has more often than not resulted in a favorable situation for selling premium. Let's go to the likelihood report. Okay, what we do here is we look at distribution bands, and we're seeking just to establish a benchmark in terms of how often the distribution bands get struck. And these are 1 standard deviation bands from the close set 5, 10, and 15 days in the future, both above and below each close. And you could see the benchmark distribution here, where these bands are struck roughly 23 to 32% of the time, roughly. 23 to 32% of the time. Now, Then when we go to our market condition, okay, there's been 209 instances where our market condition has occurred without the consecutive incidences, with the consecutive incidences removed. 209 unique occurrences. Now, when those have occurred, of those 209, okay, it strikes the upper 5-day distribution band far less than the benchmark. Do you see that? Difference of 19%. And all across the board, you have each of these distribution bands getting struck less often. This is pretty significant here. This is a picture of lower market volatility, where the market is moving in a less volatile fashion than normal. That's what we can express here. Now, does it mean it's not going to move and go get crazy? No, it just means that in the past, after our current market condition has occurred several times in the past, with each of those instances, you add them all up, it would appear that it's less likely than normal that the market will move in the normal volatility it's at. It seems that it's very likely that there will be less volatility. If the price exceeds Friday's high, similarly, lower levels of market volatility. If it exceeds the low from Friday, similar. Although these differences are much smaller than those above. So if it goes above the high on Friday, of Friday's high, you have a much slimmer chance of there being market volatility of a normal type than if it were to go below the low on Friday. If it goes below Friday's low, we're much more closer to the normal market volatility level there. Okay, so that's that report. Oh, and also we do recast our bands using the skew adjusted VIX. Similarly, though, you have across the board lower levels of the distribution bands getting struck. And so this is definitely a picture of lower market volatility across the board. Okay, so those are the reports. Let's go to the methodology for those of you who are new, and we'll be glad to explain all this. So let's go to the Condor Butterfly Timing Report first. And sometimes folks look at a market, they see that it begins to channel, and then they'll just put on their Condor or Butterfly, believing that that market can continue to chop around. Well, if you had, in this little example, if you had run this through our algorithms, okay, you would find that we actually had a negative edge here, negative 4.2. Now that meant that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. Negative edge, you wouldn't want to do a Condor Butterfly, going into the teeth of when it's more likely than normal to be, super volatile. In this case, it was much more volatile. It turned out to be a little bit predictive there, quite a bit predictive. So the question here is this current condition a good one for selling option premium through range trading? All right, and that's a great question to ask, right? I mean, you just don't, you don't necessarily have to pick the third Thursday or the fourth Monday or whatever of the month to put on one of these option premium selling strategies. Let's look at the market, look at the condition, and see if there's an edge. And that's what we're going to do. Here's how we do it. We observe how much the market actually moves from a given close, and we call that actual volatility. We also observe what market move is predicted by the option prices. We call that implied volatility. We compare the two in retrospect and label them favorable or unfavorable. So here's an example. You could take a close, move forward in time, and ask yourself, how far did the market move farthest, either up or down? And in this case, it moved down 50 points. That's the farthest it moved from that initial close. 50 points turns out to be 2.4%. It was a 2.4% move. And we have a little indicator down there. Now, at that time of that close, the question is, what market move at the time was being implied by the option prices? 2.4%? Well, when you crunch the numbers, it turns out that it was implying that the VIX was implying a move of 4.4%, much higher than the actual. So we're going to paint that bar, okay, that closing bar in the SPX. In retrospect, we're going to go back and paint it blue and label it favorable. And we're going to label all the bars favorable, where the implied move was much greater than the actual move, and where you have the market moving more than what was implied, we'll label those bars red and label them unfavorable. Okay, so what we do then is we go back and get a benchmark. What percentage of all the bars going back turned out to have been favorable? Then we go back and look at all the bars that match our current condition, 317 of them, and we ask ourselves what percentage of those were historically favorable for selling premium. And we compare the two and see if there's an edge. So when you go back and look at all of these, all 4,300 plus, 65% turn out to have been favorable for premium selling, blue bars. Okay, now of those bars that match our current market condition, okay, and you can see that there's some consecutive ones there on the left. What percentage of those were favorable for selling premium? And it turns out to be almost 72%, 71.9. So that means we have an edge of 6.9% in that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. Okay, so that's how we come up with our edge there, looking at favorable and unfavorable, looking at the VIX and comparing it to the actual move. Before we get to the likelihood report, just want to point out that we have a fantastic Discover Options curriculum. Go to the website, give us a call. We'll walk you through this, helping you to get to be the best trader you can be in as short of time as possible. We have a great series of classes. We give you homework. You get to meet with a mentor with a one-on-one session with a recorder running so you could go back and listen to it. He's looking over your shoulder at your screen, helping you along, and I think you'll find this to be a very rewarding experience if you're ambitious and want to become a great options trader. So check us out. We would love for you to come aboard here. Let's look at the likelihood report and dive in here. The question here on the table is, since Jan of 2000, how often has this same condition occurred, and what did the market do in terms of direction and volatility? Okay, so we're first going to look at the price distribution and understand that. We do this, we need to understand how price is distributed so that we can go back in time, examine what happened when the market achieved the same condition we have now. And how do we do this? We do this through by observing how often price touches our distribution bands, or I'm calling them 1 standard deviation volatility bands. These are placed from each bar's closing price. I set them 5, 10, and 15 days out. I use a 1 standard deviation level from the close using a 20-day statistical volatility number log normally distributed. Here's just a quick example. You have a close, timeout, okay? You have a 10-day band up above, 10-day band underneath. Question is does price go up and hit the upper, the lower, or wobble in the middle? In this case, it hit the upper band. So for that close, we record that it hit the upper band. Over here, similarly, we have 10-day band above and below. Let's see what the market did. Well, it tried. Check it out again. It's going to try and go down and hit that lower band, and it just barely fails to. Do you see that? So for that close, we record that it hit neither. And so for every close, in fact, we record whether price struck the upper or the lower 5, 10, and 15-day bands. And what we do then is we get a we get a distribution all figured out here. So you can go back over the last 4,300 closes. Price struck that upper band 29.6% of the time, the upper 10-day band 23, upper 15 23, lower 5-day band a little over 29, the lower 10 about 29, lower 15 about 32% of the time. So this is our benchmark price distribution. Okay, now we're going to look at when our specific market condition developed and see what the distribution was then. And we're going to measure it not only as of the close, but we're going to look at the distribution in those cases where price goes above the previous day's high. If it goes above Friday's high, we want to know what the distribution was in the past when it had that kind of behavior. Also, we'll look at what happens when the price goes down below the low of Friday. And there could be a big difference, and that'll make a difference then on Monday when you're ready to go. So here we are. We have the, as of the close, 209 closes. Price struck the upper 5 far less often, and the 10 less often. Do you see this? Way less often here. Way less often, and so this is a picture of lower market volatility. Okay, and there I was showing you the differences there. You know, minus 19, 9%. All of these differences showing lower market volatility. Now, if price goes above the high on Friday, look at that. It's touching these bands even more. Even less often, and the differences are much greater even then. See that from the baseline. And then if price goes down below the low on Friday, the distribution of price in those 100 incidences were such that they were striking those bands a little bit more often than the previous if they hit the high, but still less often than our normal benchmark up here. Do you see that? Also, we like to cast the bands using a skew adjusted VIX, meaning that the upper bands are closer to the close than the lower bands because of the VIX skew going on. And even when we adjust for the skew, we see that every single measurement is less than the benchmark. So clearly a picture of likely lower than normal market volatility moving forward here. No guarantees, of course. I mean, you have these 7-10%, items here, or areas, but in general, I think we have a very clear picture that it's very likely that the market will be less volatile than normal. Okay, folks, thanks for joining me. I'm Steve Lentz with Discover Options. Stay tuned. We'll be back next week. Same bat time, same bat channel. Take care. Bye-bye.